If you've been keeping an eye on the economy, you know the Federal Reserve just dropped a major bombshell by cutting interest rates for the first time in over 4 years. We're talking a half-point cut, bringing rates down from 5.3% to 4.8%. This isn't just a tiny adjustment, it's a big shift. Now, why is this happening? Well, inflation has cooled off quite a bit. Back in mid-2022, inflation was at a painful 9.1%, but now we're sitting at a much more comfortable 2.5%. That's close to the Fed's 2% target. So what they're doing now is trying to support the job market, which is starting to show signs of weakness. Companies aren't hiring as aggressively, and we're seeing the economy slowing down in general. But the timing is interesting. It's just weeks before the US presidential election. Coincidence? Maybe not. This decision could really shake things up as voters start thinking about who's best to steer the economy. Let's dive deeper into how this move will impact different areas of the economy and your finances. Alright, so why is this rate cut such a big deal for the economy? The Fed uses interest rates like a thermostat. Raising them cools things down, and lowering them heats things up. When rates are high, borrowing money is expensive. So companies hold back on expansion, and consumers are less likely to take out loans for things like houses or cars. That slows down the economy, which is what we saw over the past 2 years. But now that inflation is under control, the Fed is basically saying, okay, time to get the economy moving again. Lower rates make it cheaper for people and businesses to borrow money. That means you'll likely see more companies taking out loans to expand, hiring more workers, and more consumers buying big-ticket items like homes and cars. For the housing market, this is particularly interesting. Mortgage rates have already dropped to an 18-month low. And with this rate cut, they could go even lower. So if you're thinking about buying a home or refinancing, now might be a good time. But let's not forget we're still dealing with high costs for groceries, gas, and rent. The average person might not feel relief right away. However, the hope is that these lower rates will create a domino effect, leading to more jobs and more spending, eventually boosting the overall economy. Now let's talk about the stock market. Stocks usually love rate cuts because lower rates mean cheaper borrowing for companies, which can lead to higher profits and increased investments. We've already seen some positive movement in stocks after the Fed's announcement, but be careful, this boost might not last forever. The market could still be nervous about slowing economic growth, and if corporate earnings don't meet expectations, we might see more volatility. All right, let's talk about crypto and Forex. The crypto market is always a bit of a wild card, right? So how do rate cuts affect it? Well, lower interest rates often push investors toward riskier assets, and that includes cryptocurrencies like Bitcoin and Ethereum. When traditional savings accounts and bonds offer lower returns, people start looking for higher returns elsewhere, and crypto could see a boost. However, crypto is also extremely sensitive to broader economic uncertainties. If the economy continues to slow down, or if there's any kind of panic, people could flee from risky assets like crypto and go for safer investments like gold or stablecoins. So it's a bit of a double-edged sword. On the Forex side, a rate cut can weaken the US dollar. This happens because lower rates make US investments less attractive to foreign investors, leading to reduced demand for the dollar. For those of you trading in currencies, keep an eye on pairs like USD-EUR or USD-JPY, as they might see some fluctuations. A weaker dollar can benefit US exporters by making American goods cheaper for foreign buyers, but it could also raise the cost of imports, leading to higher prices domestically. What can we expect next? The Fed hinted that they could cut rates again before the end of the year, possibly 2 more times. In 2025 and beyond, we might see even more rate cuts as they try to balance growth and inflation. However, these cuts won't solve all economic issues overnight. We're still dealing with high prices for essentials like food and rent, so the average person might not feel the impact right away. But overall, cheaper borrowing could help stabilize the economy. What should you do with this information? If you're a homeowner, consider refinancing your mortgage if rates continue to drop. For stock market investors, now might be a good time to reassess your portfolio, as the economy could shift into a more growth-friendly phase. For crypto and Forex traders, stay alert. Markets will likely remain volatile as investors react to this news and future cuts. Always keep your long-term strategy in mind and avoid making impulsive decisions based on short-term market swings.